So, how does a startup with zero revenue get $100 million in valuation? Yep, it actually happened. A founder pitched me with this wild ask. So, let's break it down together today. My name is Shuo Chen. I am a former entrepreneur, now investing in entrepreneurs and teaching entrepreneurship at Stanford and Berkeley. I'm also a board member at Decode, the largest entrepreneurship community co-hosted between Stanford and Berkeley students and alumni. These are the secrets to closing your first fundraising round. All right, so first things first, a startup with zero revenue getting $100 million in valuation isn't as insane as it sounds. In the startup world, especially here in Silicon Valley, valuations are oftentimes more art than science, especially at the early stages. It's often not about how much you're making now, but about how much someone believes you'll make in the future. So at its core, it's really about the story that you're telling. To what extent can you show the potential? To what extent can you show how much risk you've already de-risked? Investors don't really just throw money at anyone. They're really looking for the risks you've eliminated so far and the potential upside that you're bringing to the table into the future. So let's talk about factors that affect valuation the most: team, market, and traction. Starting with the team. Investors love founders with an impressive track record. It makes their job a whole lot easier. Why, you might ask? Well, because it minimizes risk across the board, minimizes execution risk, team risk, obviously, and oftentimes even technology risk. Founders with experience are just better at attracting and keeping top-tier talent, and they also tend to avoid rookie mistakes. This is not surprising because it is true for every single profession, not just limited to entrepreneurs. And of course, experienced founders are also less likely to have co-founder breakups, which is the number one reason why startups fail. Now, if you've already built 3 unicorns, congratulations. You've basically unlocked a cheat code in the startup world. But what about the rest of us mere mortals? Let's break down how your background might stack up. Here's really how to think about track record. Track record oftentimes could come in the form of a number of factors, ranging from a big exit from a prior IPO or acquisition, a small profitable exit through acquisition. Even if you failed after a previous fundraise like a Series A, that counts as a track record as well because you were able to successfully raise a round. Could also be that you fundraised and failed prior to raising your first ever round. Could be that you've never raised and failed but previously ran a business. It could be that you sold a traditional business that's not a startup that's driven by technology necessarily. Could be that you're an early employee, not a founder, but let's say you were one of the first 20 employees. Track record could also be that you were an executive at a big tech company. If you were an executive at a unicorn startup, if you were an executive at a small startup, or if you had any other kinds of senior roles, or you just spent years working in the tech industry. And of course, it doesn't even have to be years worked in the tech industry. It could just be in the most relevant industry to the startup that you're going to build right now. When we're thinking about track record, there are factors that do not matter as much as well. And these are things like how much money your investors made from your previous exit, how much money you personally made from exiting, as well as your previous income before doing the startup. So it might seem obvious that how much money you made for investors or how much money you made for yourself seems to matter, but really fundamentally it is about the core of the business that you built. And of course, your previous income before doing the startup might seem like it's relevant as well, but really it has a lot to do with your opportunity cost, but not as much, again, as the core business of this new company that you're about to build. Keep in mind, though, it is promising when investors see that you otherwise could be making a lot more money, but you're leaving that lucrative opportunity to focus on building this new startup. And remember, it's not just about what you've done, but how you frame what you've done to highlight your ability to tackle the challenges ahead. Another factor affecting valuations, that is the market. The larger your TAM, total addressable market, the more excited investors often get. A massive market is like a magnet for funding because it indicates a huge opportunity. If your startup is targeting $1 trillion opportunity, investors can think, hey, even a tiny slice of this big pie could make us incredibly rich together. Big TAM equates big potential, which oftentimes justifies for higher valuation. But here's the catch. Investors are betting on the future. A small TAM today could explode tomorrow, while a huge TAM today might shrink over time. So you do care about the growth rate of what market you're targeting. So really what matters is how your future TAM stacks up against the current one and whether or not it's on a fast growth trajectory. Also, keep in mind for your own reference as a founder, when you're trying to validate a market, you're not necessarily looking for a huge TAM because the more focused you are, the more you're able to build a really good solution for this particular problem and get to product market fit faster. So keep in mind that a huge TAM and a fast growth trajectory matters predominantly for valuation purposes, but for building purposes, you definitely do want to focus on the core of your business. Finally, traction. Now, here's the kicker. Traction doesn't always mean revenue. It could mean things like number of users that you have, the kind of partnerships that you've established with other amazing companies, or even just if you've already built a super cool product that's got buzz on social media that you can showcase. Investors are always looking for evidence that your startup is gaining momentum. It's all about showcasing sustainable and scalable growth, not just any growth. So, if your startup has some revenue or user numbers to flaunt, you're already in a great position. But of course, demonstrating monthly recurring revenue or MRR is particularly powerful because it shows consistency and scalability. Investors love to see that your product or service meets a repeatable need, not just a one-time sale. So being able to showcase any kind of a recurring revenue really grabs investors' attention. But here's the catch. Growth rate is important. Investors want to see rapid expansion, and retention plays a huge role in that as well, of course. So you can demonstrate current revenue, but you do also have to showcase what that looks like month over month. Sometimes investors are willing to look at data that's even week on week or quarter over quarter or year on year, depending on how long you've been operating for. So being able to break down that revenue growth rate is super important. And of course, as part of growth, there is expansion and retention. So what is the purpose in showcasing both? Well, it showcases that your customers keep on coming back and wanting more. So it's a sign that your product is truly sticky. In fact, you're still in the game if you have a high and consistent growth rate and high retention, despite having relatively lower revenue numbers. For consumer startups particularly, investors prioritize user growth first, then followed by retention, then lastly, any kind of recurring revenue that you can showcase. And of course, in all of this, diversification also matters. So if one customer makes up more than 95% of your revenue, that's not ideal because investors want to see that your revenue is diversified across multiple customers, proving that there's a genuine market demand. And of course, it's even better if you can show that your customer profile is scalable and replicable. Other factors that affect valuation can unfortunately include things like hype and FOMO. If your startup is in a hot and hyped up market, your valuation is basically on steroids and can skyrocket. Hype-driven markets are fueled by a mix of genuine potential and investor FOMO. When investors see their peers piling into a deal, they're eager to join the action. Sometimes momentum alone can inflate valuations faster than a trending meme stock. Right now, AI is in a hype market, and sprinkle those two letters into your pitch, and suddenly a lot of startups see much higher valuations. However, keep in mind that not all valuations reflect ultimately what your startup is worth. And it is, at the end of the day, a balancing act. Because here's the flip side. High valuations come with high expectations. Investors don't hand over cash for fun. They want their money to 3x, 5x, 10x, 50x, and maybe even 100x. A $100 million valuation means that investors are betting on the founders to turn that into at least $1 billion. So the higher your valuation, the harder it is to 3x, 5x itself by the next round that you're fundraising. It means that you as a founder have to have at least 3 to 5 times more traction, more growth numbers, more customers, more revenue in order to justify being able to raise the next round if you don't want to raise a down round. No pressure, right? And let's just say down rounds aren't fun. Down rounds are incredibly hard to raise because you have to apologize to prior investors on why your company is now worth less. And you have to somehow convince new investors that there's something really new happening at your company, that you're able to raise better and have more promising prospects. Now, for some science behind all the madness, let's talk about valuation benchmarks, at least now in 2024. Most early stage startups fall into one of these valuation tiers. If you're just starting out with a founder, an idea, or an early prototype, you'll likely be in the single digit million range. As you move forward and start showing progress, such as product development, user traction, or even some revenue, your valuation can rise into the high single digits or low teen millions. When you're starting to really get into the tens of thousands of monthly recurring revenue, you're starting to look at low to mid teen in millions of valuations. And when you reach the hundreds of thousands of monthly recurring revenue, this is when you're starting to look at mid teens to above 20 million in valuation. If you've had prior successes, such as building a unicorn or leading a super successful IPO, of course, your valuation could start to look in the double digit millions right off the bat. And you're talking about anywhere between 20 to possibly even $50+ million in valuation, even if you're starting in super early stages and you have minimal data and numbers to show. All in all, in closing, when you hear about startups with insane valuations, like $100 million valuations and more, when they have no revenue to show, it's usually because they've checked off every single criteria for de-risking that business, and they're building in a hot sector like AI. Hopefully, this information at least helps gives you a different and fuller perspective into how investors think about how to value different startups. We hope that this video on how to value your startup has been helpful to you. Please feel free to like, comment, and subscribe, and we would love to share more information based on what you're excited to hear.